Ask anyone who went from broke to comfortable what they regret buying, and the answers land in roughly the same place every time. A car, a house sized for guests who never visit, a watch nobody actually noticed. What almost nobody regrets is the boring stuff, the purchases that made their body work better, their hours worth more, and their downside smaller. Those upgrades never showed up in an ad. So here are 12 of them, ordered by how much they hand back, starting with one you can fix this Sunday afternoon. Every item on this list passes the same test. If a purchase stops paying you the moment nobody is looking at it, it belongs in the other category, the expensive one. Interest compounds whether or not anyone admires it. A crown you never needed keeps paying for the next 30 years. Those are the upgrades that survive a decade of hindsight, and the reason so few people make them is that none of them photograph well. Number 1. Where your cash actually sits. The Federal Deposit Insurance Corporation puts the national average savings rate at 0.38%. The legacy accounts at the biggest banks in the country pay 1/100%, which is the polite way of saying nothing at all. And as of this month, the strongest high-yield savings accounts in America are paying right around 4.1%. Run that against a real balance. Say you have built up $40,000 in cash because your income went up and you sensibly stopped keeping 3 months of expenses and started keeping 6. At 1/100%, that $40,000 earns you $4 over a full year. At 4.1%, the same money earns roughly $1,640. The balance is identical, the money is just as liquid, and the federal insurance sitting behind it is exactly the same. All that changed is which institution is holding it. Corinne, a hospital administrator in Ohio, kept 11 years of savings at the bank where her father had opened her first account. She was not being careless. Nobody had ever given her a reason to look at the number, because banks do not mail you a letter when your rate quietly falls. When she finally moved the balance, the annual difference covered her homeowner's premium with money left over. This upgrade has 2 halves, and the second one matters more as your income climbs. The first half is the account itself, which takes about 20 minutes online. The second half is the size of the cushion. Back when you were earning less, 3 months of expenses was a reasonable target. Once you are earning enough that a job loss means replacing a large salary in a slow hiring market, 6 months becomes the floor, and 12 is not paranoid. A deeper cash reserve also lets you carry higher deductibles on every other policy you own, which lowers those premiums permanently. So that is upgrade 1, and it costs you a Sunday afternoon. Number 2, your sleep. Rand Europe ran the arithmetic on what insufficient sleep costs the American economy and landed on a figure of up to $411 billion a year, which works out to 2.28% of national output. The same research found that adults averaging under 6 hours a night carry a 13% higher mortality risk than adults sleeping inside the 7 to 9 hour range. You already know sleep matters. What gets missed is that you cannot buy the sleep, but you can buy nearly every condition surrounding it, and the conditions do most of the work. Price it per night, because that is the honest way to evaluate anything you use daily. A $2,000 mattress used for 8 years costs about 68 cents a night. Blackout blinds run under $100 and last a decade. A fan or a window unit that holds the room in the mid-60s costs less than the streaming subscriptions you forgot you were paying for. That entire package prices out below a cup of coffee per night, and it touches every waking hour that follows. Malachi, a warehouse supervisor who moved to overnight shifts at 34, spent 4 years assuming his exhaustion was a scheduling problem. He upgraded the room instead of the schedule. Room darkening blinds, a mattress that had been in continuous service since his college apartment, a machine that produced enough noise to bury the daytime traffic outside. His sleep did not become perfect, It became roughly 4 hours longer per week, which across a year adds up to 200 hours of consciousness he had been donating to a badly built bedroom. And this is why it sits on a money list rather than a wellness list. Every decision you make about your career, your portfolio, and your spending gets made by a brain running on whatever sleep you handed it the night before. Sleep debt shows up as impulse purchases, weak salary negotiations, and panic selling. You will never see those costs on a statement, which is exactly why they go unpaid for so long. Number 3, your contact points. There are 3 objects touching your body for more hours a year than anything else you own, and they tend to be the 3 you spend the least on: your shoes, your tires, and whatever you sit in while you work. Start with footwear, because the arithmetic is brutal and simple. A $200 pair of shoes worn 300 times costs 67 cents per wearing. A $40 pair that falls apart after 60 wearings costs 67 cents per wearing as well, except your feet, knees, and lower back absorb the difference. Cheap footwear is rarely cheaper. It just distributes the payment across your body instead of your bank account. Tires are the only part of a $50,000 vehicle that ever touches the road. Every dollar you spent on that car routes through 4 contact patches, roughly the size of your palm. People will finance a luxury trim package and then buy whatever tire is on sale, which is a strange way to allocate money when stopping distance is the variable that decides whether the rest of the car ever matters. Then there is the chair. If you sit for 8 hours a day across 250 working days, that is 2,000 hours a year in one piece of furniture. A $900 chair that lasts 10 years costs you 4.5 cents an hour. The same person will replace a phone every 2 years without blinking and then spend a decade in a chair that is slowly rearranging their spine. Delphine, a freelance transcriptionist, worked from a dining chair for 6 years and treated the resulting back pain as a personality trait. The chair that fixed it cost less than 2 months of the physical therapy she had already paid for. The rule underneath all 3 is the same. Price anything by the hour you use it, not by the sticker, and the expensive option frequently turns out to be the frugal one. Number 4, the air and the water inside your house. The Environmental Protection Agency estimates that Americans spend approximately 90% of their time indoors, and that concentrations of some pollutants indoors run 2 to 5 times higher than typical outdoor levels. For certain compounds, indoor readings can exceed outdoor readings by more than 100 times. Sit with that for a second. You have almost certainly checked an air quality index before deciding whether to go for a run outside. The air you actually breathe for 22 hours out of every 24 has probably never been measured at all. The upgrade is unglamorous and cheap relative to what it protects. A true filtration unit sized for your main living space and your bedroom runs a few $100s, with filters costing perhaps $80 a year. If you cook on gas, a range hood that vents outside rather than recirculating is the single highest value fix in the house, because nitrogen dioxide concentrations in gas cooking homes run dramatically above those in electric homes. Water is the same story. A filter that handles your specific municipal report costs less than a single month of bottled water delivery. None of this is about longevity mysticism. It is about the fact that you have already accepted a monthly cost for filtered internet, filtered streaming, and filtered coffee, while the substance entering your lungs 16 times a minute passes through nothing at all. Josiah, a father of 2 in Phoenix, bought filtration after his younger daughter's asthma attacks kept landing on high pollen weekends. Her rescue inhaler use dropped enough over the following year that the equipment paid for itself in copays alone, and that ignores the nights nobody spent in an emergency room. Number 5, your health floor. This one covers dental work, vision, preventive screening, and strength. 4 things that share a single property, which is that deferring them does not remove the cost. Deferral raises it. A filling that gets ignored becomes a crown. A crown that gets ignored becomes a root canal and eventually an implant, and the price roughly triples at each stage while the discomfort escalates ahead of the invoice. Nobody skips dental work because they enjoy the pain. They skip it because the bill arrives today and the consequence arrives in 4 years, and human beings are very bad at pricing that trade. Vision follows the same curve. So, does the screening your doctor mentioned that you have been meaning to schedule since roughly the last presidential administration? Strength belongs on this list too, and I want to frame it as infrastructure rather than aesthetics. The ability to carry your own groceries, get off the floor without help, and stay in your own house rather than a facility is the single largest variable in what your 70s actually cost. Long-term care is the expense that quietly dismantles retirement plans built by otherwise disciplined savers, and the muscle you keep is one of the few inputs you control directly. Once your income rises, the correct move is to spend that money on the maintenance you postponed while you could not afford it, rather than on the upgrades you fantasized about while you could not afford them. That distinction is worth more than any investment return in this video, because a body that works is the asset generating all the other income. Number 6, your commute and your proximity to your own life. The Census Bureau puts the average American one-way commute at 27 minutes, and 9.3% of workers travel 60 minutes or more each way. Convert that into a real annual figure, and the number stops being abstract. 27 minutes each direction across 250 working days comes to roughly 226 hours a year. That is close to 6 full 40-hour working weeks, spent sitting still, generating nothing, arriving nowhere you wanted to be. For the 60-minute group, the total is 500 hours. 12.5 working weeks every year, permanently. Now price the upgrade. Suppose moving closer to work costs you $500 more per month in rent or mortgage, which feels like a significant hit to most household budgets. That is $6,000 a year. If the move takes you from a 60-minute commute down to 20 minutes, you recover about 333 hours annually. You are buying your own time back at roughly $18 an hour. Ask yourself honestly whether you would sell an hour of your life for $18. Almost nobody says yes. And yet the default arrangement in American life is to sell hundreds of them every year in exchange for a slightly larger kitchen. Bree, a claims adjuster outside Atlanta, ran exactly this calculation and moved 11 miles closer to her office into a smaller unit. She lost a second bathroom and gained back 9 hours a week. Within 18 months, she had used that recovered time to finish a certification that raised her salary by more than the rent difference, which means the upgrade eventually paid for itself and then kept going. Proximity is the rarest kind of purchase, because time is the only asset on this entire list that cannot be replaced once spent. Number 7, buying back your recurring hours. Everything in the previous item applies to housework, and people resist this one harder than any other because it feels like an admission of laziness. Do the arithmetic instead of the guilt. Take your total compensation, divide by the hours you actually work, and get an honest hourly figure. Now compare that against what it costs to hand off the recurring tasks that consume your evenings. Cleaning 3 hours twice a month at $35 an hour comes to $2,520 a year, and it returns 72 hours. Lawn service, laundry delivery, and a grocery order that arrives at your door each follow similar math. The objection is always the same. Anyone can clean their own bathroom, so paying somebody else feels indulgent. But you already outsource constantly without flinching. You do not grow your own food, sew your own clothes, or change your own transmission. The line between acceptable and indulgent outsourcing is drawn by habit, not by arithmetic. There is a real condition attached, and I want to be direct about it. This upgrade only works if the recovered hours go somewhere. If you buy back 72 hours a year and spend all of them scrolling, you have purchased a slightly more comfortable version of the same life. If those hours go into rest, into your children, into the certification, into the side income, or into the relationship that was quietly starving, the return is enormous and immediate. That condition applies to every remaining item on this list, so keep it in mind. If this is the kind of money conversation you want more of, subscribe and stick around. I break down one of these decisions every week, with the arithmetic shown rather than assumed. The next 5 items are the ones people postpone the longest, and they happen to carry the largest downside. Number 8, your tax return. The Internal Revenue Service estimates that individual taxpayers spend an average of 13 hours and around $290 preparing and filing their own returns. Professional preparation for an individual runs roughly $220 at the simple end and up toward $800 as complexity grows. For most of your working life, software was genuinely adequate. Once your income rises, once there is equity compensation or rental income or a side business or a spouse with a different filing situation, the software is answering the questions you knew to ask. A competent preparer answers the ones you did not. And this filing season in particular rewards professional attention because the rules changed substantially. There is now a form called Schedule 1A that carries 4 deductions which did not exist a few years ago. Tipped workers can deduct up to $25,000 in qualified tips. Qualified overtime is deductible up to $12,500 for single filers and $25,000 for joint filers. Interest on a loan for a vehicle assembled in the United States is deductible up to $10,000. Taxpayers 65 and older get an additional $6,000 deduction. Every one of those is available whether you itemize or take the standard deduction. Meanwhile, the state and local tax cap rose to $40,400, which flips the itemizing decision for a great many households that stopped itemizing years ago. The standard deduction for this year is $16,100 for single filers and $32,200 for joint filers. Alton, a restaurant manager in Nevada, filed with the same software for 9 consecutive years. The preparer he finally hired found 2 missed items in the current year and amended 2 prior returns. The refund covered the fee more than 6 times over, and that was before any forward-looking planning had happened, which is the actual point. Preparation is compliance, a report on decisions you already made. Planning is the upgrade, and it happens in October rather than April. Number 9, disability insurance. The Social Security Administration's own actuarial projection for people turning 20 in 2025 is that 66% of men and 71% of women will reach normal retirement age without ever having been disabled. Read that from the other direction. Roughly 1 worker in 4 will lose the ability to earn at some point before retiring. Now hold that against coverage. Analysis from the American Council of Life Insurers puts more than 51 million American households without any disability coverage beyond basic Social Security. Nearly 54% of non-retired households uninsured against the single most probable financial catastrophe of a working life. Life insurance protects the people who depend on you. Disability insurance protects the machine that generates every dollar this video has discussed. Your income is the asset. The 401k, the house, the emergency fund, all of it is downstream of your ability to work. And that ability is the one thing almost nobody insures properly. Two details determine whether a policy is worth owning. The first is the definition of disability. An own occupation policy pays if you cannot perform your specific profession, and any occupation policy pays only if you cannot perform any job at all, which is a far harder standard and dramatically cheaper for the insurer. The second detail is where you buy it. Group coverage through an employer typically replaces around 60% of base pay, excludes bonus and commission income, arrives taxable if your employer paid the premium, and disappears the day you change jobs. Bree, from earlier, added an individual policy alongside her group plan for a premium roughly equal to her phone bill. She has never used it. That is the correct outcome, and it is also why so few people buy one. Number 10, your liability limits and an umbrella policy. Here is a gap almost nobody notices until it is too late. Your assets grew over the last 10 years. Your liability limits did not. Auto policies tend to carry whatever limits were selected on the day the car was purchased, frequently back when the owner had almost no net worth to protect. A serious at-fault accident involving multiple injured parties can generate a judgment well beyond those limits, and the balance comes from everything you have accumulated since. An umbrella policy sits above your existing auto and homeowner's coverage and extends liability protection by $1 million or more. In 2026, the average annual premium for $1 million of personal umbrella coverage runs roughly $300 to $400, with the ordinary market band stretching from about $250 to $550, depending on your state, your household, and your drivers. Each additional million typically adds somewhere between $75 and $150 a year. Think about the ratio there. For roughly $1 a day, you protect the entire balance sheet that took 2 decades to build. Insurers require you to carry meaningful underlying limits first, which is a second benefit, because raising your auto liability limits is itself one of the cheapest protective moves available to an American household. This is the item that separates people who have money from people who are simply earning a lot. Earning a large salary protects none of what you have already built, and structure is the only thing that does. Number 11, your estate paperwork. The most recent Caring.com study found that 24% of American adults have a will, 13% have a living trust, 4% have some other estate document, and everyone else has a plan written entirely by their state legislature. Dying without documents does not mean your family sorts it out informally. It means a probate court applies a statutory formula that has never met you, appoints an administrator who may not be who you would have chosen, and names a guardian for your minor children according to a hearing rather than your judgment. 4 documents cover almost everyone. The will directs your assets and names guardians for your children. A durable power of attorney lets somebody pay your mortgage while you are incapacitated. Your healthcare directive keeps your family from guessing in a hospital corridor at 3 a.m. And for larger or multi-state estates, a revocable trust keeps the whole process private and out of probate entirely. Now the detail that catches even organized people. Beneficiary designations override your will. The retirement account, the life insurance policy, the transfer on death registration on your brokerage, all of those pass by designation regardless of what your will says. If yours still names an ex-spouse or a parent who has since died or nobody at all, that is what governs. It takes about 15 minutes to log in and verify every one of them, and it is the single most consequential quarter hour on this entire list. An attorney-drafted plan for a straightforward household typically runs somewhere between a few hundred and a few $1,000s depending on complexity and state. Compare that against a contested probate, which routinely costs multiples of it and takes years. Number 12, your own earning power. Every upgrade so far protects, recovers, or redirects money you already have. This last one raises the ceiling on all 11. The tax-advantaged room available to an American worker this year is substantial. $24,500 into a 401k, $7,500 into an individual retirement account, $4,400 into a health savings account for individual coverage, or $8,750 for family coverage. Combined, a worker with the right plan access can shelter more than $40,000 in a single year. None of that room helps you unless there is income flowing toward it, which makes the skill that raises your income the highest returning purchase available. A certification that costs $3,000 and adds $8,000 to your annual salary returns its price in 5 months and then compounds across every remaining year of your career, including the employer match it drags along with it. No investment in your brokerage account behaves like that. The cheapest version of this upgrade costs nothing at all. Learning to negotiate a salary, learning to read a compensation package, learning what your role actually pays in your market. An hour of research and one uncomfortable conversation has moved more household net worth than most of the investment advice on this platform. Corinne, the hospital administrator from the beginning, eventually did both. She moved her cash and then she moved her salary. The bank change earned her $1,600. The conversation with her director earned her $11,000 every year permanently, and it took 20 minutes. That is the whole list. Notice what almost none of it required. No inheritance, no market timing, no side hustle, no 6 in the morning routine. 12 decisions, most of them boring, several of them free. All of them still paying long after the excitement of any purchase would have faded. And if some of this arithmetic was new to you, that is not a personal failing. Almost none of it gets taught anywhere. I put together a full breakdown of the money lessons schools never taught, and it covers the ground sitting underneath everything you just heard. Before you go, I want to hear from you. Tell me in the comments which of these 12 you have already handled and which one you have been quietly postponing, because I promise you are not the only person who has been meaning to check those beneficiary designations for 3 years. If there is an upgrade you would have cut from this list, say so and tell me what you would put in its place. And if you made one of these moves years ago and can now see exactly what it bought you, write that one out in full, because that is the comment somebody else needs to read tonight before they spend $50,000 on a car.